actual inflation to remain low? No, not the case, says my guest today. He says government policies to prop up the economy are bound to put forward upward pressure on prices in the future. In other words, a bet on inflation. For more, Gregor Carle, Fidelity International's head of fixed credit, joins us from Hong Kong. Fidelity is one of the biggest independent fund managers in the world, and Carle helps manage some $180 billion in assets there. Good to have you with us, Gregor. Inflation in the pipeline. What's the argument for that?
Well, I think a lot of people have come through this original start of the year looking at a deflationary environment, and we've come through that. And one of the important things is that maybe some investors have overlooked is that if we look at the returns you've had on inflation-linked bonds since the start of the year relative to regular nominal government bonds, actually inflation-linked bonds have outperformed with returns of more than 5% compared to regular government bonds. Now, in a deflationary environment, that probably has a few people scratching their heads, but really the message that we're conveying is that, as part of your portfolio, inflation-linked bonds are something that people are going to have to consider more in the future than they have in the past. If we take, for example, what's expected to happen in inflation in the US in the coming months, we're in an environment just now where we're seeing negative inflation, i.e. deflation numbers. By the time we hit December, it's certainly possible that we could be up north of 2% towards 2.5% inflation in the US, just based on the year-on-year base effects. And I think that's going to come as a surprise to some investors, and therefore they're going to have to start thinking about inflation as part of their investment decision, and therefore inflation-linked bonds.
Talking about scratching the head, I mean, people are wondering what's going to happen to interest rates. What's your take on it? Where are rates headed globally, as well as here in this part of the world in Asia?
Well, I think, if we look broadly at the major markets driving those movements, our thoughts around this are certainly that rates are probably likely to stay lower for longer. I certainly think that we're not going to see rate hikes come through until the latter part of next year into the end of next year, and probably led by countries like the UK, where inflation is maybe going to be more of an issue. If we look at the market, it's currently pricing in about 2% over the next couple of years. So certainly the market's expecting those hikes to come through. But I think we're more likely to see an aversion from this risk of double dip. We're going to see central banks waiting a bit later, letting inflation come in, making sure there's less risk of us slipping back before they actually decide to raise rates.
Gregor, I'm going to bring in my guest, Roger Groby of LGT. Gregor was saying that traders will have to factor in that inflation will be climbing. I mean, how do we trade under such an environment?
When you see that, in particular, emerging market bond funds, they had a huge rally behind, and of course, the spreads has been normalized. We see some exuberance already in the high yield market, and this backed by the view that we all share that there's an increasing debt situation among the governments worldwide. So there must be some inflation coming in the near future. But our house is also, we share the view that interest rates will remain low for the foreseeable future, and this will be a challenge maybe in 1.5 to 2 years. So there's plenty of time to prepare. But still, in current environment, we do not trade government bonds as an attractive investment, and therefore we shift more towards equities, and also part of our strategy will contain inflation-linked bonds, actually.
Not even high-grade government bonds?
Not even, no. Because of course, they had a huge rally behind, and they're vulnerable to any corrections. So we really starting reducing the exposure in this bond market.
Gregor, in terms of strategy, you like high-grade corporate bonds. I mean, take us through your strategy.
Yeah, I mean, I think, one of the most important things we're focused on is just, there's a lot of investors out there who are in cash or they're in equities, and many of them don't think that much about fixed income. But really, if you look at the pickup you're getting between cash and some of the asset classes you just mentioned, you look at investment-grade bonds just now, you're getting practically nothing in cash, where you're getting 5.5% if you're looking at US investment grade. If you're looking at high yield, which we still think relative to where cash and certain other asset classes are just now, yielding more than 11%. For investors, I think there's still some attraction in being able to move out of cash, into an asset class which is maybe not as volatile as equities, and still having the outlook of getting a decent return. So I think so long as we've got cash rates where they are just now, I think we're going to continue to see demand for the asset classes of investment-grade corporate bonds, which of course are somewhat secluded from defaults as those continue, and also high-yield bonds where, yes, we've had a fantastic rally since the start of the year with returns of anything up to, for example, in Asian high-yield, 65% total returns year to date. But I think it's still an attractive asset class when you're looking at getting nothing on your cash in the bank.
How about junk bonds? Any opportunities there?
Well, junk bonds, obviously we refer to them as high-yield bonds, depending on the time in the cycle. But certainly we're continuing to see some opportunities in there. But clearly, I think the important thing is that right now it's about research. We're in an environment where defaults have certainly increased, and therefore fundamental research has never been more valuable. That's going to make the difference between high-yield funds that perform well as we get through this cycle and those that don't do quite as well.
Gregor, before we let you go, what else should investors be looking at? What else should they be doing?
Well, I think investors have to have some confidence. There's a huge amount of stimulus that's been put behind the markets. We have quantitative easing, which of course is a feature that's been heavily used in Japan, but is also an unconventional approach being adopted by the major economies. And a lot of this is going in to support the investment-grade market. So I think investors have to have confidence that there are still opportunities out there, and when cash rates are this low, there's certainly things which are worth looking at, particularly if you don't have the stomach for some equity volatility after we've had such a strong run in the equity markets. So I definitely think it's a part of the market that's worth looking at.
Gregor Carle, Fidelity International's head of fixed income, joining us from Hong Kong. Thank you so much for joining us today.